Ours is different structurally. They just have the option of life. We just specify But that is so what we did is we step further and said, when you have this, you have to get it in freeze. And then you have to be freeze instead of guide. And again, and so and that's a big part. Especially
all right, folks, we're going to get started. Ask a few of you to take your seats.
No chance.
You can We'll try and get increasingly creative throughout the course of the week. And Katie, can you help us understand how well our audio is coming through for the live stream folks?
Sure, let me know.
All right. Welcome everyone in the classroom, joining us virtually. Katie, how many folks do we have joining us so far?
24.
24. All right. So it's really kind of extraordinary for us to be able to do just a bit of this hybrid this week, both in classroom here in Fort Collins, and also welcoming all of you who are joining us remotely to the 16th annual Conservation Finance Boot Camp. We're thrilled to have you with us. We're glad you could join. Just a little bit of what to expect if you're three-dimensional or joining us virtually. We are going to run a mic in the classroom so that folks who are joining us remotely can hear the questions from the room, and vice versa. We are going to have Katie representing all of your questions virtually so that we can participate with you here in the classroom in 3 dimensions. Just a couple quick bits of housekeeping. We are going to ask that you keep yourselves muted and your video off just so that we can better manage some of the tech and IT on our end. We do ask that any questions that you have, you insert into the chat box. And again, Katie will be your diligent representative here in the classroom to make sure that David answers any burning questions you may have. Same goes for all of you as well. You can ask questions as we go, of course. And then just to note, this session is being recorded and will be made available to everyone, virtual or live stream. So access to recording will be shared probably sometime next week. Stay tuned for that. And with that, it is my absolute pleasure to introduce David Hoffer, who I've been in. This is my 10th boot camp, but I think it's David's 12th. Yeah. And beaten only by Brad Gentry, who has attended, there have been more boot camps than years, so probably 17. So thrilled to introduce David for our Principles of Finance from an Investor's Perspective session. Thank you, David.
Thanks, Lee. So my name is David Hoffer. I am the president and one of the partners at the Lyme Timber Company in Hanover, New Hampshire. We are a TIMO. That's the first acronym that I'm going to define. Someone can hold me to the swear jar if I don't define one. A TIMO is a Timberland Investment Management Organization, essentially a private equity firm that invests in timberland and other rural real estate that has conservation attributes. We are focused in the US and Canada. We currently have about 1.5 million acres around the United States, about $1 billion of assets under management. And we raise capital from investors, from high net worth individuals, pension funds, foundations, endowments, corporations, and they entrust us with their money to invest in the kinds of assets that we focus on. So we have investment strategies that revolve around sustainable timberland, harvesting, and ecosystem services, a bunch of other things that I'll talk about. The firm was founded in 1976. Had a couple of people come up to me today and say, "Oh, you folks founded this industry," which is a little intimidating because now I have to sound like I know what I'm talking about. But the way I like to think about it is that I think we have made almost all of the mistakes that you could possibly make in this business. So part of my objective here is to help all of you avoid making some of the mistakes that we have made, and would welcome any conversations. Happy to talk with folks about projects or issues that you're struggling with. I'm here through tomorrow evening. My partner, Peter Stein, arrives tomorrow afternoon, and he will happily answer questions as well. So this is sort of an interesting session, building a little on what Lee and Jackson and Brad talked about in the last hour. And what I'd like to do is provide an overview of the perspective of private investors in the kinds of projects and assets that we're talking about this week. And I'm going to do it at a couple of different levels. I'm going to talk about what a deal looks like, at least in our world. And this is not the only type of deal out there, but I think it'll help to show sort of in a diagram what the different components are, who's involved in a deal, what has to happen in order to make it come together and make it be successful from a financial and a conservation standpoint. We'll do a quick case study to illustrate that framework. I'm going to then take a step back and talk more generally about what private investors value and need in order to participate in a transaction. There were some questions in the introduction about, well, what's involved in attracting private investment capital to a transaction. We'll talk about that a little bit. And then we're going to zero in on the sort of principles of basic finance. And the challenge in doing this and in the interest of building a common vocabulary and a common set of terms is that there are people in this room who have MBAs and who have been in the investment business for decades. I suspect there are people in this room who don't know how to launch an Excel spreadsheet. And so I'm going to talk at a pretty basic level to try to bring everyone up to a common denominator of language and of terms. And then hopefully that'll be useful in the rest of the week. So that's preview. And would welcome questions. So I'll take questions at the end, but if I say something that just completely confuses you, feel free to interrupt me and I'll try and answer then. Okay. So Let's talk about what a transaction looks like. So in order to have a conservation finance transaction, there are just a certain number of components that absolutely have to be there, no matter what shape that transaction takes. So first of all, you have to have an asset. You have to have, whether it's a piece of property or some conservation objective, you have to have, typically somebody owns a piece of land that has conservation attributes, and that might be a TIMO, it might be one of the public real estate investment trusts, REITs, that own timberland or publicly traded in the stock market, individuals, families, corporations. Somebody typically owns a piece of property that the conservation community wants to do something with. And you need to figure out how to finance either the acquisition or the implementation of a project involving that property. So that means somebody needs to come up with some money. And the first piece of that is who's going to actually put the equity capital, the capital that's being put at risk in order to make this transaction work. And there might be individuals who are interested in putting up capital. And when I say putting up equity capital, I'm talking about with the expectation of earning an investment return. We're not talking about donations. We're not talking about PRIs. We're talking about investing and expecting to get a return on that investment. And so, pension funds, foundations, endowments, these sorts of folks are, typically have some capital that they're interested in investing in transactions like this. In some, but not all cases, there have been a bunch of questions today about what it takes to bring in debt. And so in some cases, it's possible to find someone who will lend money into the transaction. And whether you can, as the person or the group putting together this transaction, whether you can borrow money is something that we'll talk about later in the week, and the observation of a transaction where somebody guaranteed the interest payments in order to show that the organization was capable of borrowing money is a creative example of that. But anyway, there are various types of lenders out there. There are banks in some circumstances. There's an opportunity to borrow money using some more esoteric programs. The Federal New Markets Tax Credit Program is a program subsidized by the federal government designed to create incentives to invest in underserved, below the poverty line census tracts in the United States. And so there are opportunities to use that investment incentive in order to borrow money. PRIs, there are clean water state revolving loan funds that can be brought to transactions where there's a clean water element, loans from NGOs under the right kinds of circumstances. So you need to have an asset, you need to have sources of financing. But what else do you have to have in order to have a successful investment transaction? Well, you need to have various, at least one, but maybe various sources of return on that investment. How is the investment going to generate enough of a return that the entities that put the capital in the first place are going to get their money back plus whatever return they expect? So in our world, often that involves sustainable timber harvesting. It may involve the sale of conservation easements, what we often structure as working forest conservation easements. There may be ecosystem services opportunities on a particular piece of property. So payment for ecosystem services, or PES, that's our next acronym. Recreational leases, leasing land for hunting, fishing, other recreation, and so forth. And so in order to put a transaction together, there need to be these, some set of sources of return. Otherwise, the folks who are putting in the equity and putting in the debt aren't going to be willing to agree to put in the capital because there's no way they're going to get their money back. And then ultimately, at least in our world, where we raise capital from investors who expect that after 10 or 15 years, they're actually going to get their money back and they can go put it somewhere else, there needs to be a buyer. There needs to be someone who, after we have conserved the property, sold the easement, done the carbon offset project, generated revenue from ecosystem services will then buy the property from us, and we can go and return the capital to our investors, pay off the debt, and move on and do the next one. So I don't claim that this is the only framework for a transaction out there, but I think you'll find that this is a useful way of thinking about different transactions as we go through the week. So let's apply this to a specific example. I know there are several folks here from Pennsylvania. Back in 2017 and 18, actually two of our funds bought about 67,500 acres of premium hardwood timberlands in north central Pennsylvania. This is, as the Pennsylvania folks know, some of the best land in the world for growing black cherry. Very high value species of timber. And so we purchased the property here from two other TIMOs, and did so by modeling out all the different pieces of this diagram to figure out where was the capital going to come from, what were the sources of return, what could we generate by way of return in order to make the people who put up the capital happy that they did so. So what this looks like in the framework that, just a couple of words then about what that consisted of. So 67,500 acres. The equity capital came from, as I mentioned, two of our investment funds. Talk about that in a moment. And we had some creative debt financing in this transaction. We were able to secure $50 million of debt from the Pennsylvania Infrastructure Investment Authority, also known as PENVEST, which is in the business of lending money to organizations that are promoting better water quality throughout the Commonwealth of Pennsylvania. And in many cases, they are lending to developers of gray infrastructure, water treatment plants and other assets that are cleaning water after it's already been contaminated. We made a case ultimately successfully that if we could conserve the headwaters of a number of river and stream systems in areas that created clean drinking water for citizens of the Commonwealth, that fit within the mandate of protecting clean water. So they had a very attractive debt program that we were able to participate in. And then we were able to borrow money from a conservation NGO that we've worked with over many years, the Conservation Fund, in connection with our commitment to sell working forest conservation easements, which I'll talk about in a moment, in order to permanently protect the land for the benefit of Commonwealth of Pennsylvania. And the plan was do sustainable timber harvesting, subject to third-party certification. We also had a plan which we moved forward with to invest in a couple of sawmills that would buy the timber that we harvested and then market it to markets we would have otherwise had trouble reaching. And then a political effort to assemble the public capital with the assistance of the Conservation Fund to sell working forest conservation easements to the Commonwealth of Pennsylvania, the Department of Conservation and Natural Resources. So that was the thesis. And what it looks like is we had two sellers. The Forest Land Group and Hancock Timber Resource Group, two other TIMOs, had 67,500 acres that we bought from them in a couple of different transactions. The equity capital came from two of our investment funds because it bridged the period of time when one investment fund was finished and the other was just getting started. So we had two. We had these two sources of debt financing, PENVEST, which was 20-year debt at 1% interest, with the first 5 years interest only. So just outstanding, very attractive terms for borrowing money, made it possible for us to structure this investment in a way that would generate an acceptable return. And then this debt financing that was very helpful from the Conservation Fund in connection with working forest conservation easements. Sustainable timber harvesting, investment in a sawmill, and sale of conservation easements. The sale of conservation easements has been somewhat more of a challenge. We have run into stiffer political headwinds in Pennsylvania than I think we anticipated, but that continues, and we're still cautiously optimistic that at least some of that capital will come in for the sale of working forest conservation easements. And ultimately, at some point in the next 5 to 7 years, I expect we will sell the property, hopefully the entire operation, along with the sawmills and some other businesses that we have invested in Pennsylvania, to another buyer, whether that's a TIMO or some corporation that's interested in owning timberland where we have done some conservation, managed it sustainably, improved the harvesting operations so that we can demonstrate that there's good cash flow that's a good investment for a buyer. And that will allow us to return capital to pay off the debt, return capital to investors, and move on. Yes. Let's see, I think, do we need a microphone for
Maybe you could say name and affiliation when you're asking the question.
Thank you. This is Josh Daskin from Archibald Biological Station in Florida. I'm just curious to understand very naively a little bit more about the future buyer piece. If you have these sources of return on the right, which my understanding correctly are supposed to cover the debt, why do you need to sell it off? And do you sell it off with conservation easements for the whole thing necessarily, or other conditions on what can be done at the end?
So very good questions. And there are a couple of questions, so let me unpack them. The sources of investment return are those that will flow to the benefit of our investors during the time that we own the property. So sustainable timber harvesting generates regular cash flow from the sale of timber. That's something that we will do. That's something that a future buyer could continue with. We've made these investments in sawmills. Ideally, an investor will want to step into our shoes, also own those investments in sawmills. They'll get the benefit of that going forward. It's not that these are only to pay off the debt. These are generating ongoing returns that every year pay the interest on the debt and generate distributions or dividends to investors. But there's not a one-for-one correlation that once we do one of these things, the debt's going to get paid off and it goes away. The expectation is that the debt will remain in place. And then then to answer your question, why do we need to sell it? We raise funds, investment funds that have a fixed term, typically between 12 and 15 years. And we tell investors, our investors, folks up here, that they're going to get their money back. And so we essentially we can't own the asset forever. We have to sell it to someone else. But if we have sold it subject to, for example, conservation easements that will encumber the property in perpetuity, we might be able to sell it for less than we bought it for. I'll have a slide on that in a moment. So it's a good deal for the buyer, but it also means that the buyer is subject to the restrictions of that conservation easement in perpetuity. So we've taken an unencumbered piece of property and encumbered it in the course of our ownership. Does that answer your question?
Mostly, but go ahead.
Okay, follow up.
Well, the chat also was wondering, how does this, how do we ensure that the conservation values will be protected in perpetuity?
I'll repeat that because there's no mic. How do we ensure that the conservation values will be protected in perpetuity? So in this particular example, the conservation values will be protected through the sale of a working forest conservation easement, assuming that that is successful over some or all of the property. Our conservation easement gets recorded in the land records. It's an encumbrance against the property that's there in perpetuity. It's enforceable by the holder of the easement, which in this case would likely be the Pennsylvania DCNR. And so if a future buyer were to violate the conservation easement, the DCNR would be able to go after them in the court. Yes, Mike.
I'm Kate Rama from National Lands. You had mentioned that your debt financing, I'm assuming from the conservation fund, came with an option to buy. Did that affect how your easements were written, or is the option to buy only on some components of the project and the easements on others?
So the option to buy, so the reason the conservation fund was willing to lend us money at low rates, which they did, was that we gave them an option not to buy the property in fee simple, but an option to buy a conservation easement. And so it gave them a period of time, I think it was 5 years, I could be wrong, during which they had the exclusive right to buy a conservation easement on that property if we couldn't do anything that would interfere with their right. And their role is to go to the Commonwealth of Pennsylvania and try to assemble the public funding that will allow them to exercise that option. As a technical matter, what has happened in similar transactions before is that the conservation NGO that plays that role gets everything all teed up, gets the funding. The easement has been pre-negotiated typically with us, so they know exactly what it is they have an option to buy. And then in the last instant, they assign that right to the government agency, and the government agency actually closes and becomes the holder of the easement. So the conservation fund is not ultimately in the chain of title. They don't own it. They just have facilitated the transaction. Let me move on. I'll take more questions at the end, just because we have a lot to cover. So I just wanted to we'll zoom out a little bit, and I've given you a framework for transactions. We've talked about an example. More broadly, why is it that private investors have a role in this market? That may be intuitive to some, but it's not always intuitive. And the fact is that sources of capital have become a whole lot more competitive. It's no longer a certainty that that you can transfer land to a public agency shortly after acquiring it. There's a lot of land out there that remains unprotected, and private investors have a lot of capital at their disposal that can be deployed in these sorts of transactions. And we've seen a growing role for private investors, which is part of what the Lyme Timber Company has been doing for the last number of years. Impact investment is on everyone's lips and in every publication you read. And there's an increasing focus within the conservation community, not just on pure preservation, but on conserving working landscapes, which plays well into the kinds of assets that we tend to invest in. The growth of ecosystem services markets, carbon offsets, wetland, stream mitigation banking, species banking, nutrient trading. There's all sorts of ways that the market and science have come up with to monetize and create incentives to conserve conservation attributes. The regulatory regimes that have risen up to support those kinds of markets have become increasingly robust. And there's just a lot more capital out there in the private sector than there is in the public sector. And so what investors are looking for in transactions of this sort is to partner with folks who have access to public and philanthropic capital, because that is, as we just discussed, critical to the investment thesis of a conservation finance transaction. Looking for access to deals that others wouldn't have access to through partnerships with conservation NGOs, and looking to build a reputation for being a reliable conservation partner that will do what the private investor says it will do. The issue is that, and we'll talk about this as we go through the presentation, is that investors are very, very selective. There are a lot of boxes that have to get checked in order for a transaction to be attractive to a private investor. So investors are interested in working lands for all the reasons. I won't read them here. It's a stable investment. We have all sorts of economic turbulence right now, so there's perhaps even more rationale for why this is something that folks are interested in. Lots of return drivers that are of interest. There's some inflation hedging and a relatively low correlation with the public stock markets and otherwise. So when markets start doing crazy things, there's increasing interest in investments like these, and lots of different sources of value that are increasingly becoming attractive to investors. We've talked about some of these traditional and more innovative revenue streams, but investors are very selective. And so just before we dive into the finance portion and then pull it all together, there is this sort of symbiotic relationship that we have experienced, I think has been obviously beneficial to both sides, between conservation NGOs and private investors. Conservation NGOs, when they work with a private investor, know that there's capital available, that there are no rules about how the deal gets structured. You can, we've put together all sorts of crazy, complicated deals in order to fit particular circumstances. There's some appeal from a land trust in working with private investors because it keeps properties on the tax roll. It generates it preserves jobs. There's some appeal to more fiscally conservative donors because there's this sort of private-public partnership flavor to the transaction, and there's a greater level of efficiency and credibility in working with a private investor that is going to follow through, and you're not waiting on a donor to decide whether or not they want to support a particular project. And then, of course, investors are relying on conservation NGOs in order to vet the conservation attributes, the conservation priority of a particular property, and in many cases, leaning on a conservation NGO to help assemble the public funding and work with the public agencies to come up with the money that's going to make it possible to execute and implement some of these transactions. I want to come back. I talked about working forest conservation easements, WFCEs, as a tool that we use. And I just want to give a quick overview for those who aren't familiar with them. So the basic principle here is that when you buy a piece of property, you're buying all of the rights associated with it. You're buying the right to, you own it. You could cut some of the trees, you can cut all the trees, you could develop you can mine for coal, you can put up shopping malls, you can subdivide it and sell it off in 40-acre lots. You've got all the rights available to you. And what a working forest conservation easement does is to extinguish some of those rights and to eliminate the right to convert the forest to some other use. In most cases, to subdivide it into a lot of different pieces, and in all cases, to harvest it in an unsustainable way. What it means, though, is that you're reserving the right as the landowner to harvest it sustainably. And so the rights that are extinguished are sold in an instrument. It's a legal document, it's many pages long, and the buyer of a conservation easement is essentially paying the landowner to extinguish those rights. And then if the landowner or a future landowner violates the conservation easement, then the holder of the conservation easement can sue. So you sell a conservation easement, what you've done really is to diminish the value of the property because you have sold off the right to do a bunch of other things with it. So the optionality, the option to follow some of these uses that are not consistent with conservation has evaporated. What we do is we then hold on to the land. We find ways to optimize the operations, to do more efficient harvesting, maybe to sell some ecosystem services, generate some, demonstrate the ability to generate cash flow, and then ultimately sell it to another buyer for a price that may end up being less than we paid for it, but we've gotten paid along the way for the conservation easement and for the harvesting that we've done, the ecosystem services that we've sold. And so a working forest conservation easement typically follows this sort of pattern. And again, the landowner, whoever owns the land, whether it's us or a future landowner, is bound in perpetuity to abide by the terms of that conservation easement, but it allows for the continuation of sustainable timber harvesting. So that's the key reserved right that makes it possible and makes it of interest to another TIMO, another timberland investor, to buy it because you can still do sustainable timber harvesting. So let me take a pause there, see if there are any questions, because I think I shut some down earlier, and then we'll move into the finance. Yes.
Thank you. My name is Kit Rimmer. I'm with the Friends of Wildlife, Northwest Florida Central Landscape. We're very fortunate. We have hundreds of thousands of acres in North Florida, they're owned by TIMOs. you know, as you're talking about the lands are gonna acquire, that's the Florida Wildlife Corridor. A lot of these lands are within the Florida Wildlife Corridor. So for long-term protection, can you explain, because I understood TMOs are a short-lived thing, but maybe only funds, you know, certain pieces of TMO or all? Because I always heard that, you know, you can only count around a TMO for 20 years and then something's gonna happen. So can you explain
Sure.
how that evolves over time for us partners that are trying to conserve conservation lands forever?
Yep, absolutely. We own about 90,000 acres in Northwest Florida, as you may be aware, and have sold conservation easements over about half of them through a series of sales to both the state of Florida and NRCS. Natural Resources Conservation Service. So the answer is yes and yes. So TMOs, organizations like the Lyme Timber Company, the Hancock, you know, the Forest Land Group, others that I mentioned, are perpetual organizations. They hopefully last for a very long time. But the reason you hear about some of these short-lived periods is that typically what TMOs do is that they raise investment funds that have a fixed life. And so investors say, okay, I'm going to entrust you with my capital. I want you to go and find attractive timberland properties with conservation attributes to invest in. But I only want to give you my money for 10 years. And I want to know that 10 years from now, I'm going to get my money back. So essentially what that means is that we as the TMO have 10 years to try and work our magic and achieve the conservation and streamline the operations and do whatever it is that we're going to do, put carbon projects in place and demonstrate cash flow. But then we have to sell it because our investors in that particular fund are expecting their money back, and we've committed that they're going to get their money back. We'll then go and raise another fund and we'll go invest in something else, but that fund typically also has a fixed term. And so there are these staggered funds. Now, beyond the scope of this conversation, one of the things that we've been thinking about for a number of years is whether there's an opportunity in the timberland space to raise a perpetual fund that does not have a fixed period of time. And that's a whole other conversation. It's something that we're looking at. But historically, the vast majority of capital in this industry has been raised in these fixed term funds. And that's why there's a period of time. Now, to your question about how to partner with these organizations in a way to ensure this perpetual protection, the kinds of transactions that I'm talking about here, whether it's a carbon sequestration project with a 100-year term or a working forest conservation easement that has a perpetual life, those things will survive the 10-year period. And when the TMO sells the property out of that fund to someone else, that encumbrance will persist. It's just that the underlying owner will have changed.
We do have, yes.
Yeah.
So who provides the endowment to the land trust or government agency for defending the conservation easement?
Who provides the endowment to the land trust or the government agency to defend the easement? The thrust of the question, I think, comes from what is often the way land trusts work with conservation easements, which is to accept donations. And donations are typically paired with an endowment fund that somebody has to come up with in order to ensure that the easement is enforced. The easements that we convey are a bit of a different animal. They are, first of all, on a much larger scale, and they're also not donated. They're sold at fair market value. And so what usually happens is that there is a source of funding from some state agency, whether it's the Florida Forever program or in Wisconsin, the Knowles Nelson Stewardship Fund, the variety of state funding sources that will provide for the acquisition of conservation easements. And it's sort of their business how to figure out how they're going to manage the endowment. So is it conceivable that we might sell an easement and have to fund an endowment? Yes, I can't think of a time that's happened in the last 10 years or so. But if we did, we would just bake it into the investment underwriting, which is the next section that we'll talk about. And if we could afford to do it, we'd do it. And if we couldn't, then we do something else. Yes.
Okay. I'll get it over here.
Okay, you want to pass it up?
Oh, he's got a question. He's gonna hold on to it.
Dylan O'Hare with Palm Lake Conservancy. So it looks like in phase 3, that's the opportunity for the land to really appreciate and change in value. How does Lyme, or does Lyme prioritize properties that have, that aren't being managed well? Because there is an opportunity to really increase the value yourselves. And if so, I guess, how do you evaluate those properties?
I think the answer to that is yes. Do we I mean, the answer is there's a finite number of deals that come across our desk in any given year. So let me answer it this way. It is more likely that a property that has not been managed well is going to be an attractive investment target, because in all likelihood, the owner doesn't, the current owner doesn't realize what they're sitting on, and doesn't, in their expectation for what they're going to sell it for, isn't taking into account the possibility to improve operations. So we look, we do our own modeling, we figure out how could we operate, how could we manage this property, what kinds of cash flows would that generate, and then we figure out what we can pay for it, and maybe we're able to reach a seller's asking price because they don't have the same understanding that we do of how the property could be optimized. I wish there were so many deals out there that we could just, cherry pick the ones that were not well managed. As a practical matter, though, it does flow into how we evaluate these transactions. Hello.
Thank you. Jason Swan, Trust for Public Lands. When I'm hearing this, the first thing that comes to mind is bond laddering. I don't know if you're familiar, but it's just the same type of concept where you have a bond, a fixed bond, it comes to maturity, and then there's another bond that ladders that and goes to the next one and the next one. So I'm curious about the concept with this, if there's a potential to have more individual investors come in, and ones that are not well endowed to be able to invest in it and receive some, interest payments or some sort. Has that been a thought or a suggestion or an idea?
We have a lot of investors in our funds. We're a bit unusual in that many other TMOs have mostly institutional investors. And so a fund will have 7 or 8 pension funds, and that's it. We've got something like 500 investors across our existing funds. And I'll tell you that it is administratively a challenge to manage that many investors, even when they're writing pretty big checks. The reason to do something like what you're describing of raising capital in even smaller chunks, I think, would be if you couldn't access that financing more efficiently through the capital markets. And generally speaking, whether it's Penvest or a conservation NGO or a farm credit system, which lends us money at attractive rates, then we might scramble for more creative solutions, even at the expense of some real administrative cost. So far, we've been fortunate enough that we have been able to raise very attractive debt financing without having to go those routes. And so it's not something that we've really explored. There was a question behind you before we hand out forward. No, it can't actually. Is it on?
Well, Lucian Reiser, what is the value of the land put into conservation easement in comparison to the land managed for forestry, and how is that value realized over time? That's part 1. And then part 2 is, assuming that value is slightly less than the land managed for timber, is there an expectation that the returns from the timber somehow make up that difference, or how do you model or factor that out?
Let me make sure I understood your question. I think what you're asking is the difference between the height of this red bar and the height of this green bar, the unencumbered land versus the encumbered land. And then how do you make up the difference? So typically the way this happens, the way that easement gets valued, is usually the buyer of a conservation easement is a public agency or an NGO that has to go by appraisal. So this is one of the few situations where we rely heavily on appraisals. Usually we do our own modeling and don't pay a lot of attention to appraisals. But typically what happens is you do a before value appraisal of the property unencumbered. You do an after value appraisal of what's the property worth on an encumbered basis. And then the delta is the value of the conservation easement. And that's the maximum that the buyer of the easement can pay. What we're then left with is this lower green bar where the value has been diminished because we have essentially relinquished the optionality of being able to do all these other things with the property. You ask how we make up that value. Well, in part, we've gotten paid for it because the public agency wrote us a check. If this is, if the value of the conservation easement is 40% of the unencumbered value, we got paid 40% of the value. We've now reduced the value, the cost basis of the investment down to 60% of what we paid for it. And then what we're doing is we're generating cash flow and doing, improving operations and maybe selling some ecosystem services over time. And hopefully the value is appreciating, and then we're selling it to a buyer here at a time when it's worth more. Now, maybe we could have sold it for more if we had not sold the conservation easement, but from an investment standpoint, and this foreshadows about 3 slides from now, it's much better to generate capital or to return capital earlier from an investment standpoint, gets us to the issues around the time value of money, which we'll talk about. I want to take one more question from Brad, but then I want to jump to the next section and hold off on others.
Brad Corey with the Nature Conservancy. How much success have you had selling easements at their full appraised value? Because these are big numbers that you're talking about here, and coming from a background with a land trust, like it's a heavy lift.
Yeah, basically, if we can't sell it at the appraised value, we don't sell it. So, I suppose you could say we've had 100% success in selling at appraised value. It's just that sometimes the appraised value is not high enough to make it worth our selling. So we've done this in Wisconsin, we've done this in New York, we've done it in Florida. There's an appraisal. What typically happens is, in a situation where we have an option agreement with the conservation NGO, as I described, there's typically a floor value. And if the appraisal comes in above the floor value, then the NGO can exercise the option and buy it from us at that appraised value. If it's below the floor value, then we get to decide. And we recently had a situation in Florida on a portion of our property where the appraised value came in at a value that was low enough that we decided not to proceed. And we're continuing to manage that property unencumbered.
And just to follow up, what size, if you're breaking down a 60,000 acre tract of land into multiple conservation easements, I'm assuming for easement funding purposes and flexibility in selling it, how big are those tracts generally?
Totally depends on the source of funding, the budget, the timeline, what state you're in. We sold our Florida easements, I think 4 separate transactions over 46,000 acres. So that's 10 or 12,000 acres each on average. We've had sales that were smaller. We've had sales that were larger. It's a function of the funding more than anything else. What's that?
Just closed on one.
We did just close on one, indeed. Okay. So this is where people like Bert and the other MBAs can either take a snooze or heckle me or whatever you like. But we're going to talk about the time value of money. And this is a concept that sort of underlies everything, how investors think about transactions. It's important to understand because it will explain some of the incentives that sometimes don't seem intuitive in a transaction. So what's the principle? The principle is $1 today is worth more than $1 tomorrow. Why is that? Because you could take that dollar and you could invest it, and it'll be worth something more in the future. It'll be worth more than $1. So if you had to choose between $1 a year from now or whatever your dollar today could generate in a year, you'd always choose what your dollar could generate. So it is this concept is useful to evaluate payments in today's dollars. You sometimes hear about the term discounted value or present value or net present value. These are all terms that we'll try and discuss without acronyms. And the concept is that the present value of some future payments is what those payments are worth in today's dollars, discounted at some specified annual rate in order to reflect risk and the time value of money. So assume a simple example. You've got $100 investment. You know that if you invest this $100, you're going to get $10 a year back for the next 5 years. And then at the end of 5 years, you're going to get $120. It would be great if the world had this sort of certainty. If we could all make these investments, we'd be retired by now. But anyway, assume that that's sort of the simple case. So on an undiscounted basis, without taking into account the time value of money, this first line, the undiscounted line, shows what would actually happen. You'd put in $100. You get $10, $10, $10, $10, and then in year 5, you get that last payment of $10 plus the 120 that you get back, so that's 130. So if you add up these 5 numbers, 4 times 10 plus 130, $170. That's the present value because you're not applying any discount. You're just adding up the numbers. Undiscounted, it's worth $170. That's the sum of these 5 numbers. And if you subtract the $100 that you put in the first place, your net present value is $70. You put in 100, you got out 170, $70 is the net present value of that investment. This is the case where money, the time value of money has no relevance. So now let's assume that we're going to discount those future payments back at 5% per year. So you put in your $100 in year 0, but then the value of that $10 that you get in year 1, if you discount that back to present value at 5%, that's only worth $9.52 in today's dollars, because you've brought it back, you've discounted it by that 5%. The math, if you're interested, is $10 divided by 1.05 equals $9.52. But in any event, that's the concept. And then, of course, the effect compounds. The value of the $10 in year 2 is only $907. Value in year 3 is only $864. Add up these 5 numbers, which represent these future cash flows discounted back at an annual rate of 5% a year. And it adds up to $137.32. Subtract your initial $100 investment, you've got a net present value of $37.32. So how would you say this in finance speak? You'd say, well, discounting these cash flows back at 5%, this investment opportunity has a net present value of $37.32. Now, look what happens as you increase that discount rate. The more you discount the money back, the higher rate you use to discount the money back, essentially the greater the time value of money is, these numbers start to go down. Now it's the first year is only 909, 826. You add these up, it's 112.42. Subtract your $100 initial investment, your net present value at 10% is only $12.42. And then the final example, if you increase this rate all the way up to 15%, so you're discounting each cash flow back at 15% a year, now all the numbers add up to only $93.18, which is less than the $100 you put in. And so if you subtract the $100 you put in from the present value of $93.18, you're actually losing $6.82. So this is fundamental because it reflects the way investors think about their capital and what sort of return their investors need to get, and how the future cash flows from an investment, whether the future cash flows come from timber harvesting or the sale of a conservation easement or the sale of carbon offsets, all of these cash flows have to get discounted back to present value in order for an investor to decide whether or not it's a good investment. So then the logical question is, well, how do you figure out the right discount rate? Is it 5%, 10%, 15%? And there's a lot of corporate finance theory that goes into answering that question. But for today's purposes, think about it as there may be some risk premium to pay. You know, the more risky the cash flows are, the higher a discount rate you might use because you're less certain as to what the outcome might be. You might think about it as the investor's required rate of return. How much of an annual return do investors have to get in order for it to be a good investment? Or the cost of capital, you know, which could be weighted between debt and equity. Anyway, there are a variety of ways to think about the appropriate discount rate. The important thing to realize is that as you discount cash flows back to present value, the numbers get smaller. And especially as the discount rate increases, the returns are harder to achieve. So again, the idea here is to put you in the mindset of an investor so you understand how someone may be thinking on the other side of the table. What investors typically do when they consider an investment opportunity is they build a model and they figure out what's the set of cash flows that we, the investor, think we're going to get from this investment in the future. How much timber do we think we can harvest? What can we sell a conservation easement for? How long is it going to take to raise the money? Are there ecosystems? You know, what can we do? What's going to happen with logging costs? If we're going to have to pay more to loggers in order to get them onto our property, then that's going to reduce the cash flows. So there are fairly complicated financial models that get built in order to consider different circumstances and then figure out what those cash flows are. Because once you have the cash flows, then you can go through this exercise of discounting them back to present value in order to figure out whether it's an attractive investment. What this brings us to is a term that many of you may have heard of. It is called the internal rate of return, or IRR. And IRR is the annualized compounded return rate of an investment. It's sort of the all-in investment return when you've got especially useful when you have an irregular set of cash flows in the future, instead of the very simple example I gave, which was $10 a year. The real world never works like that. And the real technical term, which is a little hard to get your mind around, is that it's the discount rate at which the investment will yield a net present value of 0. So come back for a moment to this chart, and you can sort of figure it out. We know that the net present value of this investment at 5% is $37, 10%, $12. Whoops, at 15%, it's negative $7. Somewhere between 10 and 15% is the rate that if we discounted those cash flows back, it would yield a net present value of 0. Call it 13%. So if I had a line for 13%, I think we'd probably see here the net present value was 0. Another way of saying that is that the IRR, the internal rate of return of this set of cash flows, $10 a year, $120 back, is 13%. That is the technical definition of IRR. It's the rate at which the net present value is 0. And it's really a proxy for just thinking about the overall rate of return. The other thing that investors pay attention to is what's sometimes referred to as multiple or equity multiple. It's the cash on cash return. You put in X dollars, you get out Y dollars. Is Y more than X? And if so, by how much? Forget about how long it takes. It could take 2 years, it could take 100 years. But the multiple simply measures the overall cash return without paying attention to the time value of money at all. So ignoring the discount rate, what percentage of capital gets returned? So a couple of, again, very simplified examples. Let's say someone gives you an opportunity and says, if you give me $100 today, I'll give you $200 in 5 years. What is the IRR of that investment? I'll spare you the Excel spreadsheet that spat out that answer. It's 15%. What that means is that if you discount back that $200 at 15% a year for 5 years, you'd come up with $100. The net present value would be 0. That's why we know it's 15%. The multiple is 2 times. Put in 100, get out 200. 200 divided by 100 is 2. So you've got a 2x multiple here. Now, let's say you negotiated with the person who offered you that deal and said, well, I'll take the $200 in 5 years, but I want to pay $100. I'll pay $80. Person said, okay. All right, so now you put in $80, you sell in 5 years at $200. The IRR, as you might expect, is higher. 20% is what it takes to discount that back to zero. Now the multiple is 2.5 times. Put in 80, get out 200. 200 divided by 80 is 2.5. None of this is particularly, exciting. But think now about an investment where there are some regular cash flows along the way, instead of just you put in money now and you get out money later. Because this is, of course, what we all are likely to be dealing with in the real world. So $100 investment, this example may seem somewhat familiar. There's $10 annual cash flow, and then you sell in 5 years at 100. So the IRR of that is 10%. And if you sort of do the arithmetic, you put in 100, $10 a year for 5 years is 50, get 100 back. So 50 plus 100 is 150. So you put in 100, get out 150, 1.5 is the equity multiple. Put in 100, get out 150. Look at the second example. You put in 100, you get $20 a year for 5 years. So 20, 20, 20, 20, and then you get 120 in the 5th year. So it's the same, I'm sorry, 50 in the last year, missed my example. So you get $20 a year for 5 years, that's 100. In the 5th year, you get 50, that's 50, 100 plus 50, it's the same $150, right? You put in 100, you get back 150. It's just that you get back that 150 a little bit sooner because you're getting $20 a year and a smaller pot of gold at the end of the rainbow instead of a larger one. So the multiple is the same. It's still 1.5 times. But because of the time value of money, the IRR here is 12% instead of 10%. This is also an important point because what it shows is that regardless of how much actual cash there is that's going to come back in a transaction, the return is deeply sensitive to the timing of the cash flows. And the earlier you can get you generate a return on the investment, the higher the return is for investors. This is a critical thing to understand about how investors think about transactions. So now, we pull all this together, the definition of the time value of money, IRR, multiple examples of how cash flows get discounted back. And what investors do in deciding whether to make an investment is they build a model, and then they consider different scenarios in what's called sensitivity analysis. So let's make this a little more realistic. Instead of dealing with $10 at a time, you can buy a timberland property for $100,000. It's going to generate $10,000 a year in timber harvesting cash flows. And here you've got a choice. You can either sell the property for $120,000 in year 5. This should be reminiscent of the example a couple of slides ago. Or you can sell a working forest conservation easement on the property for $40,000 in year 3. And then in year 5, you can sell the encumbered fee subject to the conservation easement for $90. Well, makes sense that you're selling the encumbered fee for less than you paid for it, right? Because you bought something that was unencumbered. And now, even though you've had 5 years of appreciation, you're still selling something that's restricted. Can't build on it, can't subdivide it, can't harvest it unsustainably. So you're selling for $90,000. So the question then is, how would an investor model the range of potential outcomes? So let's look at the base case. We've got a $100,000 investment. We've got $10,000 a year coming back in timber harvesting cash flows. We're selling it in year 5 for $120,000. That's the 13% IRR that we talked about a little while ago. And the multiple is 1.7. Why is the multiple 1.7? Well, you've got 10,000, 10,000, 10,000, 10,000, that's 40,000. Add it to 130,000, that's 170,000. 100,000 in, 170,000 out, 1.7 times. Okay. Now let's look at the easement. Yes, microphone. You want to try to talk real loud?
You need to use a microphone.
I'm wondering, after year 2, or after the placement of the conservation easement, why does the timber revenue modeling not decrease?
Great question. Because this is a working forest conservation easement that under which the landowner reserves the right to continue to do sustainable timber harvesting at the same level as before. What you're giving up, what you're relinquishing when you sell the easement is the right to do a bunch of other things with the property, clear cut it, convert it into condominiums, subdivide it into 40-acre lots and sell it off. You're essentially restricting it so that it will remain a contiguous block of forest land in perpetuity, but you're reserving the ability to do $10,000 a year timber harvesting on it. So that's sort of written into the conservation easement. That's the principle of it. You can't do unsustainable timber harvesting, but we weren't doing unsustainable timber harvesting in the first couple of years anyway.
So if I'm an impact investor, what's the conservation impact that I'm seeing, I guess?
The conservation impact is that when we go and sell this to somebody after 10 or 12 years, they can never harvest it unsustainably again, or subdivide it, or convert it into some other use. The sustainable timber harvesting is part of the package. And generally, especially as interest in impact investing and conservation has evolved, doesn't tend to be offensive to most investors. You're doing third-party certified sustainable timber harvesting. But now let's look at that easement line. So here, this is the second choice that we had: buy it for $100,000, $10,000 a year. In timber harvesting. In year 3, we get the $10,000 of timber harvesting and the $40,000 of proceeds from the sale of conservation easement, because we're allowed to do sustainable timber harvesting. And then we continue in years 4 and 5 to get the $10,000 a year. That $100 in year 5 is the $90,000 plus the 10. So here we've got a higher IRR. It's 16%. And a 1.8 times multiple, because we've actually gotten more total cash. But the IRR is meaningfully higher because we have pulled forward some of that cash flow, and we're getting an extra $40,000 back in year 3. And you see this even more starkly in the next example, which is, hey, what if you could get that easement in year 2 instead of in year 3? Exact same facts as before. Same $10,000 a year, same $40,000 for the easement, same $90,000 for the encumbered fee. But if you pull that $10,000 forward by a year, your IRR ticks up from 16% to 18%. It's all about the time value of money and how quickly you can return capital to investors. And then if you can not only sell the conservation easement earlier, but also increase the value of the property and sell it for 100 instead of 90, well, then you've increased your multiple to 1.9 and your IRR from 18% to 19%. And then the holy grail, if you can negotiate a lower price to buy the property and get it for $80,000 instead of $100,000 and then execute your plan, well, then you've got a 24% investment. So what this shows is the kind of modeling that happens, the sensitivity analysis that gets performed. And what investors will do in the course of their due diligence is focus on all of the facts that they can uncover that will help them figure out which scenario are they going to be in. How quickly can they sell the easement? How much will they be able to sell the property for in year 5? What can they do to increase value along the way? If you could get $12,000 a year instead of $10,000 a year in timber harvesting revenue, which I didn't show up here, you can imagine all the numbers would go up correspondingly. So that is the punchline, really, that in trying to understand how private investors look at transactions and the role that private investors play, it's critical to understand the kinds of questions they're going to ask and why they're asking those questions, because it ultimately feeds into a model like this that will tell them how much can they pay for the property is it a good investment? Is it worth moving forward altogether? We walk away from dozens of investments any given year because when we build the model, it just doesn't generate a high enough IRR to meet the expectations of the investors in our fund. And these are the kinds of questions that we ask in order to figure that out. So I'm over time, but I'll leave it to Lee as to how much time you want to leave for Q&A.
Well, we intentionally planned a longer break, David, because you pointed out
'Cause
that
I
we were
talked too long.
shortchanging your time. We usually do this session in 90 minutes, but we thought we'd, keep things fresh. So, Katie, you had two
Yeah.
questions from the live stream.
I do. So the key part of this is if there is no ability to sell a conservation easement on the property, how can we ensure that the conservation values will be protected in perpetuity?
Well, so I mean, the flip answer to that question is that you can't. It is perfectly possible for an investor to make an investment in a conventional timberland property that has no conservation thesis at all. And, then what you're doing is you're just looking to make a good investment. You're looking to buy it at an appropriate price. You're looking to generate cash flows from harvesting or whatever else. You're looking to sell it for as much as you can. That's just capitalism. Having said that, there are a variety of other tools that we'll talk about over the course of the week that can generate conservation outcomes without a conservation easement. Ecosystem services model, carbon and mitigation and other sorts of mechanisms that have evolved over the years to monetize conservation values in ways that are more or less durable in order to achieve conservation outcome. But there's no law that says that any given investment has to have a conservation outcome. That's just most of what we're talking about this week.
And second question, to revisit the endowment question, since as a land trust, we usually see it as our business to figure out how to fund the endowment. Can you walk us through how a land trust would address the endowment funding issue? You mentioned working it into the investment plan. Can you elaborate? That was a little bit back in the presentation.
Yeah. I mean, one thing I would say is that it's very rare for the ultimate buyer of a conservation easement of the scale where we operate to be a land trust. It's much more common that, we're talking about public agency funding where a land trust or a conservation NGO has facilitated the transaction, but has not, but didn't end up becoming the holder of the easement. We did a deal in Texas last year that was a hybrid of a couple of different kinds of models. We bought 9,500 acres of coastal wetlands on the Intracoastal Waterway in Galveston and Brazoria County, Texas, in part because we wanted to establish a wetland mitigation bank on the property. We didn't need 9,500 acres. We needed about 4,500 acres, but the seller was only willing to sell 9,500 acres. And so we had to bite the bullet. And so what we did is essentially to split the property. And we partnered with a very good land trust called Galveston Bay Foundation in Texas, and worked with them to help them get funding from the Deepwater Horizon settlement that was administered by NIFWF, National Fish and Wildlife Foundation. And we sold them an option to buy about 4,700 acres from us using money from the Deepwater Horizon spill. And they ended up exercising that option and buying that 4,700 acres in fee. There was no endowment associated with that, at least on our side of the transaction. I think they went out and raised capital from donors or other sources of grant funding in order to fund the endowment. But from our standpoint, we had a deal, sell them 4,700 acres at appraised value, and they took care of the endowment on their own. It was a little more complicated on the mitigation banking side, where they're going to be holding the easement, and we negotiated an endowment, which we then underwrote into our investment model and made sure that there was a line for the cash flow associated with funding the endowment, but that was on the mitigation banking side. It's a bit of a scattered answer, but many of these things aren't simple and formulaic. Yes, wherever the mic goes first.
Hi there, Charlie Carlin from Gathering Waters, Wisconsin's Alliance for Land Trust. Thanks for your good work in Wisconsin. I'm curious, we talked a couple of times about monetizing ecosystem services, whether you're doing carbon deals, the wetland bank, something else. have you run into examples or do you anticipate future issues with appraisals? Are appraisers saying, well, because the land has a carbon value or it has another ecosystem service value, therefore it maintains a higher value even when being encumbered by the easement, and so the value of the easement that you sell goes down?
So I'm going to start to answer your question, but I'm first going to warn my colleague Kit that I'm going to put him on the spot in a moment to talk about appraisals and carbon. So the answer is yes, appraisers are becoming more sophisticated about ecosystem services models and are valuing those cash flows to varying degrees, depending on the appraiser and depending on the situation, into their appraisals. Who owns the carbon cash flows is always something that's subject to negotiation. So, and there are examples of easements where the fee owner reserves the right to carbon. There are examples of easements where the carbon flow, the carbon value flows to the easement holder. And so in either event, the appraiser should be able to figure out how much the carbon is worth and whether to assign it to the easement holder side of the ledger or the fee owner side of the ledger. But it doesn't create, was your question, does it create a problem for?
Yeah, does it scramble sort of your math at all when you're thinking about how much are we able to pull out in year 2 or 3, say with the sale of the easement? If that easement is only worth, say, 50% of what you thought it was going to be worth because the appraiser said, well, you're actually keeping that value with the carbon sale.
Yeah, so there's always appraisal risk whenever there is a transaction like this with the sale of an easement. And so typically the way we structure transactions when we have a third party, a land trust that's in the mix is, they will have an option to buy an easement at appraised value subject to a particular floor. And if they don't achieve, if the appraisal comes back below the floor, then we're not obligated to sell the easement. And so that, if the carbon turns out to influence the appraisal value in one way or the other, that may put it either above or below the floor. But at the end of the day, we've sort of baked in our deal in advance. And so whether or not they're able to exercise is something that we have predetermined. Is there anything you want to add to that, Kit, or I scrambled it enough?
No, I would add that we did just get an appraisal back. Just got an appraisal back in Tennessee where there is a carbon project, and he didn't account for the carbon payments, but he did increase our discount rate. So he put that there was a risk premium associated with the carbon program rather than accounting for the actual carbon payments. So he increased the discount rate, which then decreased the value of the property.
So back to the question of how do you determine the right discount rate? I mentioned earlier that it is often a function of how risky those future cash flows are. And to the extent that future cash flows from carbon may be deemed, at least by some appraisers, to be more risky than the reliable cash flows from harvesting a certain amount of timber each year, then it stands to reason that there might be a higher discount rate that's attributed as a result of those riskier cash flows. Yes.
Who pays for the third party to verify the sustainable operation of the forestry operation?
We do. I mean, we have group, the Lyme Timber Company has group certifications under FSC, which is the Forest Stewardship Council, and SFI, which is the Sustainable Forestry Initiative. Those are the two most heavily used standards for third-party certification, and it's just the cost of doing business. We get certified every year. We have audits every, whatever the period is, every year or 2 years on each of our properties to make sure that we're complying with those. And those costs, the cost of certification, get baked into the cash flow that we are building when we're figuring out up front, do we want to do the investment? And if the cash flows, if the expenses of the investment, including certification, are high enough that it doesn't allow us to achieve a necessary IRR, then that's an investment that we wouldn't do. It's unlikely that would be driven by the cost of certification, but that's how certification gets baked into our decision making.
Last question, if we could, pass it to Mike. And also if Mike can get the mic.
Thanks. Thanks very much for all this. I'm listening to this, thinking about how to replicate this at an international level. Sorry, I forgot to introduce Mike Mwangi, regional representative for the International Land Conservation Network. I have an interest in expanding some of these ideas into Africa. I'd like to know, from your opinion, what would be the enabling factors, political and economic, if you're thinking of doing this in an African context? What would be the enabling conditions for that?
And when you say this,
I mean, doing things like this.
Yeah, that's a broad question, hard to answer when we're, so maybe we can talk about it afterwards. I also want to make sure that you talk to my partner, Peter Stein, who's been very heavily involved with the International Land Trust Association. I think that, you know, a quick answer is that one of the reasons the Lyme Timber Company only invests in the United States and Canada is that some of the mechanisms here, the ability to sell conservation easements and have them be enforceable under a set of laws that will be respected, you know, can't be replicated in all countries, or doesn't currently exist in all countries. So that doesn't mean that you can't do deals. It just means that the range of tools in the toolbox may be somewhat narrower. Plenty of carbon markets internationally, you know, mitigation markets, which I'll talk about tomorrow morning. You know, right now, wetland and stream mitigation banking is very mature in the United States, but much less so elsewhere. So I think that the fundamental principles of doing financial modeling, of figuring out how to do conservation and get paid for it, and then how to build an investment thesis that will be attractive to investors, that can be replicated in Africa or anywhere else. It's just that you may find that you're working with a narrower or a different set of arrows that you can pull out of the quiver at any given time in order to make an investment work.
Well, and I'll add for my part, the Global Environment Fund, not to be confused with Global Environment Facility, they are a timber investment management organization of sorts, not legally defined in the US in certain ways, but they have investments in Africa, mostly related to forest products, and have also due diligence projects in international legal contexts far elsewhere, including, I don't know about Central America, but definitely South America. So we can connect with them as well.
Happy to answer individual questions through tomorrow night. Don't make the same mistakes we made. Thank you, Owen.
All right, so for our live stream audience, we're going to let you on with your day. You'll get the recording to this session. Thank you so much for joining us. Have a good one. We will see you at 11 o'clock Mountain Time tomorrow morning for the next live stream session. And for those of you in person, I hope you enjoyed nature's display with the giant hawk that buzzed us and perched up here and then steadily went about its way. We're going to have a 30-minute break so folks can mill about, again, head back up to the deck, bask in the sun for a little bit, stretch your legs, get a little blood flow, because next we will be enlisting you all as consultants for Bessemer Ditch, and we will also be introducing you to a version of this that's a little more interactive, which is an introduction to project budgeting. And I believe Excel spreadsheets will be involved. So any questions before we break? Folks doing okay?
Yeah.
All right.